Hello, so in this video we'll learn how to use a Fibonacci retracement tool to trade a trending market. So we have two types of Fibonacci tools. The first one is the Fib retracement, which is here. The second is the Fib extension. They are both used for very different purposes. So in this video we're going to specifically focus on the Fib retracement tool. Also, the Fib retracement tool can be used in very many different ways, uh, depending with how you're trading and your type of analysis. But here we want to focus specifically on using the fib retracement to trade a trending market. So that's the key point. It's a trending market. So that means the market is either in an uptrend or a downtrend. So in this case, we're going to start with an uptrend. So basically an uptrend is just a market that is forming higher highs and higher lows. This is how an uptrend looks like. We have something like a channel like this. Then we have price moving from one point to the next. So we've said it forms higher highs and higher lows. It comes and forms a new higher low. And this series continues for a while. So this is what we call an uptrend, a market that is moving upwards. So in a trending market, we have two types of moves, only two. The first move, which is the move that is to the direction of the trend, we call it the impulse move. Then this other move from here to here is now the retracement. So the main move is the impulse move because we say the market is actually pushing towards the main direction. So it's creating an impulse. And then the other move, which is this one here, it's simply a retracement because it's not the main move. A retracement is just a counter move to create a correction to bring balance in the market. So having said that, let's use this example here. It's important to first note that whenever using the Fibonacci retracement, just as the name, Fibonacci retracement. So we are simply trying to find out how far will the market retrace to. So that's why we use the Fibonacci retracement. Let me use a practical example. If you look at this chart, this is 0 and Z 4 time frame. From point A, we have a low, then the market pushed up to this point. So we have this high here and this one. We cannot focus on this one because it's actually lower. We want to look at the market, or rather, we want to look at the price from the lowest point to the next highest point. And the next highest point is actually this one. So that means, because we already know that this is a trending market and it's an uptrend, this is our impulse move from point A. Maybe we can call this B. This is our impulse move. Then from point B, which is at this point, we know already that the market is now supposed to retrace. So when we have this retracement happening here, we simply want to answer the question, how far should this retracement go to? Because we've already identified that the market is moving upwards. So however much the market is retracing, at some point we expect the retracement to end. So this is where we now use the Fibonacci retracement tool. To use the Fibonacci retracement tool, it's very simple. You draw it using the impulse move. So our impulse move is from this point A to this high, which is at this point. The Fib retracement tool has 2 points. So you're going to take the tool, you click at the lowest point, and let me insist, use the bodies of the candlesticks. Don't focus on the shadows because the shadows just show price rejection. So if you want reliability, it's important to use the bodies. So you drag your Fibonacci tool from point A to the highest point, which is here. But I'm just going to extend it a little bit further to the right for perspective. But don't confuse, we are doing it from that point to this high. You put it there, then you can just drag it to the right so that you can have a wider vision for perspective. So when this market is retracing from this point, it's now selling. We're expecting the retracement to end. If you look at the Fib retracement tool, it has several zones, several price zones. We have the 0.5, 3, 2, 6, 7. So these zones shouldn't confuse you. It's important for you to note that whenever price is retracing, what we want is for the market to come back to balance. Because when price moves from one point, which is from point A to this point here, let's call it B, for a long time, without creating a retracement, price creates an imbalance. So when price is retracing, the 0.5 level is a very significant zone for you to mark because at 0.5, it means price has covered half of the move. So if price has covered half of the previous move, it means that we now have balance. Do you understand? So it doesn't mean that we only focus on the 0.5 level, but one of the most significant zones you need to watch out for your retracement to get to is at least the 0.5. It's possible that the retracement will go all the way to 0.6 or 7. But if it goes all the way to level 1, it's no longer retracement because it's now come back to the starting point. So you want your retracement to come at least to the 0.5 level and at most somewhere between 0.6 to 0.7 level. Because at this point, the market will have created enough balance. So how do you know the level where the price will go to? It's very simple. It's not in your place to know how far the price will go because you cannot determine. Because you see, we have 0.5, 6, and 7. Price is going to hit one of these zones. Sometimes you can expect it to come to 0.6 and then it passes all the way to 7, and then now the retracement ends and it starts buying. Because it's important for you to understand so that you don't make a mistake when trading. If you don't know this, you'll just be having your fib level at 0.5 and placing a buy trade. If you buy immediately at 0.5, here luckily you made money. But most of the time, if you do this, you might lose. It might come to 0.6, you might buy here, you still lose. Price might drop all the way to 0.7 before it now starts buying. So how do you know the zone that is perfect? The answer is there's no perfect zone. But as long as price is between 0.5 to 7, it's now upon you as a trader to start anticipating a possibility for the main move to continue, for another impulse move to be created. The impulse move will be created at point 0.5, 6, or 7. So how do you know the zone that it will be created? You simply now start watching the market behavior. And specifically, you watch the behavior of candlesticks. For example, price could get to 0.5 and it could show no significant reason for you to buy. So you won't just buy immediately. You'll ignore that zone until you find a reason to buy. But let's use this example here because it's a perfect one. Price came to 0.5. Then we had a long shadow here. We said a long shadow represents rejection. So when we see this rejection, we already are anticipating that maybe the sellers are now becoming weaker. Then guess what happens next? Let me just remove the tool because this is the 0.5 level. What happens next is we find a very long candlestick. Let me just mark it so that you can see. We get a very long candlestick, and long candlesticks signify that we have strong momentum. So, number one, before we use the Fibonacci tool, I want you to note three things so that you don't confuse. First thing is that we already know the trend direction. So, we just didn't do this Fibonacci anywhere. We already know the trend direction either from higher time frame analysis or maybe we have price has been forming high highs, high lows. So, we already know we are in an uptrend. So having known that, when price is retracing, we are anticipating that price should eventually continue going back up. That is why we are looking for a buy trade. So when it comes to the 0.5 level, which is a significant level, we start anticipating to get any formation of a candlestick that will signify strong buyers. And indeed, here we got a very long body candlestick. So this signifies to you that we have strong buyers in this market. So if you took your trade after this candlestick, that would have been a valid trade because price continued going up. So let's look at another similar example. So here the market is in an uptrend again. It's still UNZ. And you can see for yourself, we had a low, we had a high, a higher low. So we can already confirm that the market is in an uptrend, right? I want us to focus on this point here. This point here, let me mark it. This is where our focus is going to be. Let's assume that we already know that price moved from this point and formed a new high. So let's look at this impulse move from this point to the next high, which is there. So we want to draw Fibonacci retracement to determine how far this retracement is going to go so that we can now continue buying. So we take the Fibonacci retracement tool, we place it at the lowest point. Remember we said we used the previous impulse, of which this is the impulse. The impulse is from this point to the next. So that it doesn't become confusing, just know that you use the previous impulse move. from this higher low to the next higher high. You place the Fibonacci there, then you can drag to the right and extend it just for perspective. So remember we said we are watching for price to hit at least the 0.5 level. It's actually possible that price might not get to 0.5. There are days that it will get to 0.2 and even continue, or 3. But to be safe, remember we want to trade only high probability setups. So if it gets to 0.2 and continues buying and you miss the trade, well and good. Then you continue analyzing until you get a specific currency pair or instrument that the price will behave according to your analysis. So price should come at least to the 0.5 level. And just to make it clear, you might be wondering why we have equilibrium at 0.5. It's very simple. You see, 0.5 is simply half because 1 divided by 2 is 0.5. So 0.5 is half. So that's why I said that when price gets to the 0.5 level, it means that it has covered at least half of this previous impulse move. And if you measure, you'll be able to determine that. So price came to the 0.5 level. Let me just mark the zone and see the behavior of price immediately it got to that level. So same thing, we had a long shadow to the downside. A long shadow to the downside indicates sellers are being rejected. So when sellers are rejected, it's a good sign that possibly the retracement is coming to an end. That isn't enough for you to buy. You must be very patient before you get a trade. So what happens next is that we get a long body candlestick here. The long body candlestick signifies that buyers are now in control. So you might be safe to take your trade here. If you want to be more patient, which I always advise, you can then just wait out of the trade and be more patient. See what happened next. We had a series of red candlesticks. Then eventually we had another long body candlestick here. This long body candlestick signifies that buyers are in control. So we have the first one telling you have strong buyers. Then you be more patient, you get a second one confirming that we have strong buyers. So now at this point, you have the confidence to take your trade there. You buy there, stop loss somewhere below this candlestick. This is about 40 pips because this is the 4-hour time frame. If you use a risk reward of 1:2, you'll use 40 to make about 80. Yeah, if you use a risk reward of 1:3, for the same 40 pips, you'll target about 120 pips. Price got there eventually. So let's look at an example of a downtrend. It's just similar to the other one, but opposite because a downtrend is now forming lower lows and lower highs. This is how a downtrend looks like. We have a series of lower lows and lower highs, and it continues for a while. So when trading a downtrend, we apply the same concept, only that this time it's now the opposite direction. For example, here we have a series of lower lows and lower highs, and we can just mark them. Price moved from that point. It came and created a low here. It retraced. You can use this as a low, or you can extend it all the way to this next low. It made a retracement, then another impulse move. So for example, let's focus on this retracement here and use a Fib tool. So we'll take our Fibonacci retracement. Remember that we draw the tool using the previous impulse move. Our previous impulse move is from this point to the next lowest point, which is somewhere here. So I'm going to extend my Fib to the right. We also mentioned that we want price to retrace at least to the 0.5 level. So we'll come and mark the 0.5 level. It's possible that price could go even to the 0.6 or 7. So as long as it's in between here, we just want to look for that specific zone where we will get a reason to sell. If we get the reason to sell at the 0.7, that's where we'll take our sell trade. Okay. So in this case, we have the 0.5 level. When you look at this level, there's actually a significant pattern that was formed. When price came to this level, it formed an M pattern. So, number one thing, we already know that price is in a downtrend. Number two, we've identified the retracement successfully. So after the retracement, you have the anticipation that eventually price is going to continue to drop. So your question is, at what point does it continue to drop? So you draw your Fib level, you watch out for the zones between 0.5 to 7. Any zone where you get a significant pattern, a significant indication is where you take your sell trade. In this case, at the 0.5 level, which is actually at equilibrium because we have balance, because price has covered at least half of the impulse move, the price formed an M pattern. If you check carefully, this is a big M pattern. Let me just try to draw. So these M patterns don't have to be as perfect as the letter M that you know, because I know most of you know an M looks like this. This is how an M looks like, something like that. So when you draw these M patterns in the Forex chart, sometimes you'll find that this second top is maybe lower or higher. Especially if it's lower, it's still a valid M pattern. So it doesn't have to be exactly perfect. So if you look, we had a high. This is actually a formation of an M pattern. So we are just combining different techniques of analysis to see how we got our trade using the Fibonacci retracement tool. When you have an M pattern, you come and look at the lowest point. This is the neckline. You draw a straight line and you label it as your neckline. So when you have your neckline, you simply want price to trade below the neckline and get a candlestick close for you to confirm that the M pattern is valid. So I want you to remember that our main analysis here is not trading patterns. We are simply trading the Fibonacci retracement. So I just want you to understand how, after getting to the 0.5 level, we want to look for anything significant for us to sell. And in this case, we got an M pattern at the 0.5 level. So if price got to the 0.5 and we didn't get anything significant, we wouldn't have forced to get a sell trade. But here we got an M pattern, then we got a long body candlestick which broke below the neckline. So that confirms to you that sellers are strong. So you can take your trade there, and that's actually a successful sell trade. So basically, that's how you trade using the Fibonacci retracement, either using an uptrend or a downtrend. I hope you've understood. I'll see you in the next video.